Hey everyone, it's Imran from Options Insight with your macro options daily. It's a big week. Stocks finished last week pretty poorly, near the lows as PPI came out hotter than expected, stoking fears that CPI do the same week, and that's what it's all about. Main event's going to be CPI on Tuesday. European stocks also drifted, not quite as much. And then Japan and China kind of managed to stay in positive territory on the week. Commodities were mixed. With metals firmer, but oil and uranium down. And then nat gas reversed pretty sharply off a really bad start to the week, but finished the week slightly up on the week. Vols were firmer in the US indices. You can see they're up around three and a bit vols. Obviously, market getting a bit nervous and prepared for this week's potential volatility, and US markets seem to be more sensitive to that these days. European vols were also higher, but clearly not as much because those markets are a bit more sticky. And then Asian vols were lower on the week as those Asian markets managed to still eke out green on the week. Commodity vols were generally higher. You can see across the board, except for that big red, which is nat gas, continues to trade lower. Obviously, we've been short that. It's worked all right. We're doing okay managing that risk so far, but realized vol has popped back above 100. So it's not as clear a sell as it was when it was realizing 60 and implying 120. That was when it was a clear sale. Now it's starting to look like slightly better priced. I do think that gas at some point needs to stabilize, but right now it's winging around like a madman. I think it's up again close to 10% overnight. So this thing is not stopping moving right now. So it's definitely not for the faint-hearted, being short positions on this type of stuff. But for now, we seem fairly okay with our position, and the way we risk managed it last week seemed to work quite well. European indices continue to be the best in terms of carry. You can see a lot of positive green there from European, not so much in the US. And then in commodity space, precious metals is where the negative carry is really at. Those are the ones that are better things to be long gamma right now, whereas oil seems to be the better place to be short gamma versus where implieds and realized are right now. Copper also remains in green, showing positive carry. Looking at skew, you can see skew bouncing on the week. Across, say, S&P, NASDAQ, and the major European indices. China also seeing a bounce in puts there, up 1 vol point for that 25 delta risk reversal. In terms of commodities, we did see skew offered, except for nat gas and copper, which saw a bid to puts, despite the fact that prices are actually trading higher, but they're seeing a bit of a bid to puts there across those two commodities. In FX space, the dollar really struggling to gain much ground against the majors. Despite the risk-off tone. So historically, when markets have traded risk-off, the dollar's done all right against, say, the euro and cable. Not so much last week. So you can see those having pretty small moves on the week there. We did see yen and Canadian dollar lower on the week, though. And we saw CNH higher on the week, as obviously that China reopen story continues to gain traction as they lift various restrictions all over the place. Bonds finally having a pullback, big down day, 2.6% on TLT last week. It had been ripping and just going higher and higher every day, which was sending the implied vol higher. Implied vol did finish up nearly 2 points on the week, but you can see it had a bit of a pullback on Friday. Implied vol at 21 on TLT does look elevated, but realized vol's at nearly 30. So until that realized comes down and TLT finds a bit of equilibrium and a bit of stability, then that implied vol will probably stay stubbornly high. But if it can find a week or two, maybe into Christmas, where it doesn't move so much, they might then reprice these vols down to something a bit more normal. If you look at price, another reason why prices probably pulled back a bit on TLTs later, obviously you've got the PPI number that came in hot, but we have got treasury auctions this week in the first half of the week in the 10-year and 30-year and stuff like that. So often you do get yields going a little bit higher into those auctions. Lastly, sectors were broadly lower. Worst hit sectors were XLE and ARC, down 9% apiece pretty much. Obviously XLE tracking the oil prices that were weak. And then ARC just in general out of favor, despite duration trading pretty well. Both NASDAQ and then high growth tech were softer on the week as there are some sort of caution ahead of these, let's say, ahead of these CPI numbers this week. Okay, so that's kind of the summary. If we move on to kind of what's happening, obviously big week ahead, lots for the market to contend with. Main event, obviously, in terms of potential market volatility, is likely to be CPI on Tuesday if we go on past performance. That's going to be closely followed by the FOMC on Wednesday. We'll get the press conference out of Powell, but we'll also get the projected, the economic projections and the dot plots. So we'll get to see where the Fed is relative to the market, and we may get some moves in the rate market on the back of that. Now, clearly, the 50 basis point hike is the favored one that's being priced by markets, but it's priced at a 75% probability. So I was surprised to see there's still a 25% probability being priced by the market of a 75 basis point hike. And I think that's because the market got a bit scared that the CPI print might be quite hot on Tuesday, and then that may then mean that they need to hike 75. Personally, I don't buy it. Even if the CPI is hot, I think they'll stick with 50, and they'll just reiterate that they're going to continue to go for longer, and they'll address those problems, and they'll probably look past it. And obviously, it's the shelter, it's the core CPI X shelter, the core services CPI X shelter that they're really going to be looking at. So that's the data point that you need to watch closely. Anyway, rest of the week on Thursday, after FOMC on Wednesday, we've got Thursday with another central bank bonanza. We've got Norway, Switzerland, Bank of England, and the ECB all announcing rates. And then finally, we're going to close out the week on Friday with the biggest option expiry of the entire year, which is December OPEX. So lots to contend with, as I said. Last week, clearly, we said we had highlighted that the PPI might give a tell on the CPI number this week. Obviously, the print came in hotter. Markets reacted to it a little bit. We did also see inflation expectations data out of the University of Michigan survey that showed an easing of expectations. So that's good for the next year. The 1 year is now looking at a 1 year low in terms of expected changes in prices. That's down to 4.6. And if we look longer dated, like 5 to 10 years, the median expected change in prices, that's kind of unchanged at around 3%. And again, Powell has said these are numbers that they do look at and they do care about to see if inflation expectations are getting unanchored, basically. We still believe that the largest potential move in markets this week would be on a CPI miss, similar to the type of thing that we saw last month. But with Powell speaking the very next day, we do think there would be some reversal risk, as they would likely want to counter any large loosening in financial conditions that we would get from a big squeeze in markets. They would have the opportunity to walk that back a bit. So that's just something to be aware of. So even if you position yourself long for a CPI miss and you get one, don't necessarily expect it to follow through after Powell speaks, because he would be strongly incentivized to speak very hawkishly, to kind of pull markets back a bit, rein markets in a bit. So that's kind of how I'm thinking about it and the playbook for the week. If we look at ideas, we're looking at Euro this week. We do think ahead of CPI and FOMC, looking at where the Euro's got to, it's been pretty impressive, the rally that it staged. You can see here, it's back to about 106. We've got that as a pretty major resistance level on the chart. If that breaks convincingly, we've got another one up here at around 108.70. We do think, though, there is risk that if that CPI does come in hot, and, I'm not going to make a call one way or another if it does. It's more about just looking at the different scenarios and trying to find assets that can react based on where they are and based on where positioning is, right? So we already said on a CPI miss, we think the Nasdaq's going to rally the most. We think that's going to give you the most bang for your buck on the long side. But now if we look at the fact that equity markets have already sold off a bit last week, have already got a bit nervous ahead of this CPI, given what PPI was. But you look at the dollar and it's barely budged. We think that the euro dollar has got potential to pull back if we were to get that hot CPI, and it could easily move back down to this support down at 103.30. That would be the first stop, and then below that you'd be looking at 101.5. Sorry, sorry about my sore throat today. We're also seeing positioning, looking at CFTC data. We are seeing quite a lot of extreme long positioning building up in euro. That's something Darius called out this week on his Around the Horn. So check that out. And then we also think we do see bearish divergence. So momentum indicators that we look at are putting in lower highs whilst we're making higher highs here. That tends to be a potential reversal signal. So we definitely do see a setup for euro to come lower. Now looking at our dashboard on euro, what can we see? We can see implied volatility has been coming down. So you can see here, we've got the yellow line and the white line drifting down. Obviously, the green line has spiked, but that's because it's the weeklies and they contain the event risk. So you can see in the term structure over here, you've got the weeklies trading at around 14 vol, whereas you've got the rest of the curve trading at around 10. So there's a significant premium for options expiring at the end of this week because of the FOMC and the CPI relative to anything longer dated. Now, realized vol has been ticking lower, obviously. That's why we're seeing a positive carry here in euro. So it's not a no-brainer necessarily to own options in euro. But given where spot is, given the fact that spot has got the potential to pull back pretty sharpish to 103 sort of levels, maybe 2 to 2.5% lower, buying outright puts as a simple trade, taking advantage of the fact that 1 month vol is sub 10, is not the worst trade in the world. So that would be our basic trade idea, just to buy outright puts. We wouldn't really want to sell calls right now because, as we said, technically, if this 106 level does break on the catalyst, then you've got a quick 2 or 3 big figures against you that it can go. So just selling out upside calls with that much event risk doesn't really feel like a great trade to us. Whereas we think buying the outright puts to play a pullback, given that the vol levels are quite cheap and you can buy a 1 month put on a sub 10 vol, we think that's probably the safer way to play this. So from a trade ideas perspective, our basic trade would be, we're looking at commodities, just talking about commodity longs have been cut quite dramatically over the course of the year. Clearly, the big fear was this kind of China lockdowns that just kept happening. And then now you've got a global recession to boot that the market is pricing in for next year. So commodity exposure in terms of speculative longs is down 39% year to date. Open interest across futures is at 8-year low. So this is showing us that going into year end, even though we're starting to get a China reopening story emerging, going into year end, my throat is a mess. Going into year end, the market is still not ready to pile back into commodities, basically, right? So I would say that our strategy compass, you can see, is flagging oil as a bit oversold, bullish risk reversals there. We already mentioned uranium last week. Buying calls there looks decent as well. Some of these metals have kind of had a bit too good of a run recently, so we wouldn't be jumping into the metals right here, right now, although gold is at quite a key inflection point at around 1,800. So be careful, because if gold breaks that, it has easily got another 3-4% upside in short order. But in general, from a strategic perspective, we think strategic longs in commodities do make sense, not just for a few months, but for the next few years. We do think China is set to reopen. We think real assets in general will provide some protection from a stickier inflation picture. A lot of people think just that the secular trend in inflation has changed. We're going to get more inflation for longer, even if it's peaked. And that whole deglobalization story, along with the kind of decarbonization story as well, both those things should be supportive of commodity prices over the longer term. All right, that's it for today. Thanks a lot. Be careful. This is going to be a volatile week, so you don't want to get caught too exposed either way. And using optionality is probably a good way forward. Okay, see you tomorrow.